And right now there's this battle in the market. Is $2,000 going to remain the ceiling for gold, that it sort of tries to bump through and then always fails and goes back to 1,700? Or is it going to become the base from which it can launch to $2,000? And I think we are at the cusp of this or happening, where we will see a real price increase into the $2,500 to $3,000 level. That's real, not just tracking inflation. And this assumes like inflation manages to stay 5% or something like that. And as you know, that would only be from 2000. That would only be 20% gain, but that has massive leverage on ounces in the ground.
John Kaiser, the founder of Kaiser Research Online, showed up in the recent interview with Soar Financially. Kaiser discusses the future of gold and silver in a changing economy. He argues that gold and silver are both undervalued assets that could see significant price appreciation in the years to come. During an interview, John Kaiser expressed his views on the U.S.-China economic rivalry and its potential impact on gold prices. He believes that this intense power struggle between the two economic giants will spur a transition in the global economy, leading to new demands and opportunities. He also highlights that as the rivalry between the United States and China intensifies, there are growing indications that the BRICS nations are actively seeking to diversify their holdings away from the U.S. dollar. This pursuit of diversification is motivated by a desire to reduce dependence on the U.S. currency and safeguard against potential risks associated with geopolitical tensions and economic uncertainties. Kaiser suggests that the potential for gold prices to rise in the future is largely dependent on the factors that are currently keeping prices down. Kaiser added if the mining industry is able to find and develop new gold deposits at a slower pace, and if investors continue to shift their preferences towards alternative investments, then gold prices could rise in the years to come. Please take a moment to view the interview snippet with John Kaiser on Soar Financially. Make sure to watch the full video to gain a comprehensive understanding of the discussion. Don't forget to subscribe to our channel and click the bell icon to receive notifications about our latest content.
The real price increase, forget inflation. The real price comes from increased demand. What would cause increased demand for gold beyond trying to just track inflation? And that's why I think this power struggle between the United States and China for domination of the global economy, this is going to stimulate as a transition real new demand. And what's interesting is in the past year, I watched the GLD gold going in and out. It has largely been flat in terms of how many ounces it holds, and yet we've seen gold rising. That means there's a different type of buyer in the market for gold. And central banks have been described as accumulating a lot more gold in the past. But when you look at the net numbers, last year was actually one of the lower years where the increase in official holdings increase. It was actually much lower than prior years. From 2008 on, it's been steady, whereas before that, everybody was liquidating their central bank holdings. But the reason that this is not a correct description of what's going on is that some of these distressed autocracies, I think such as Venezuela and Iran, have been selling gold because they've got such brutal sanctions against them. But other ones, and I think these are the ones that are in the sort of global south, they have been buying gold, but that has been masked by this stress selling, which is not going to last forever because they'll eventually run out of gold to sell. But the desire to convert, say, U.S. Treasury instruments into gold, that is going to keep increasing. And I think it's the optics for the retail market and the institutional market. They want to see this uptrend. The reason for why it should continue is already in place, but it's not really believed. And I think we will see this happen. And that's where you will see the price of gold outstrip the increase in the OPEX and CAPEX. The US dollar is the primary reserve currency and is also the currency in which global economic transactions are cleared at, and it's also used for price discovery. So there really isn't obvious replacement for it unless you link the renminbi to the US dollar. So and of course they park their proceeds from their sales in treasury bills. So making this thing unreliable is creating huge credibility concerns in the rest of the world. And in my view, I think whether or not they pave this over for now and punt it down the road, the rest of the world's thinking we need to get away from the U.S. dollar as what we rely on to clear trades. And if we do see the split between global West and global East widen so that the global economy fragments into separate zones, the U.S. dollar won't be part of it. But if we go the scenario of the debt ceiling really causing everything to crash, that will be that might even ultimately lead to the breakup of the United States itself, because the pressure between the so-called right wing and the left wing, when it's really like just extreme right wing versus the middle and the crazies on the left, the United States will not survive if it goes into a kind of world war.
Kaiser emphasizes the historical resilience and adaptability of markets. He suggested that once a resolution is reached regarding the debt ceiling issue, there is a possibility of improved investor sentiment and a potential return to an uptrend. However, in the long term, it is unlikely that the debt ceiling issue will have a significant impact on the stock market or the gold market. Kaiser also highlights that it is impossible to predict with certainty the exact impact of the debt ceiling issue on gold prices. However, there is potential for significant price gains. Investors who are seeking a hedge against inflation may find it beneficial to consider adding gold to their portfolios. Gold has historically served as a store of value and a safeguard against economic uncertainties, making it an attractive asset for those looking to protect their wealth. Let's listen to Kaiser's point of view.
I mean, if costs keep going up, and one reason the mining sector suffers is that when we see these general inflation numbers, it's always worse for operating costs and capex. That always is more. That's why every time we're waiting for the next feasibility study update or so, we're expecting escalation of capital cost and operating cost assumptions that swallow up whatever gain gold has accomplished. I think whether or not a default happens, I think the desire is there to transition away from relying on the U.S. dollar, but it cannot happen overnight. This is why I think gold, after waiting 30 years for it to really start increasing real price. I mean, do you realize that you take $400 gold in 1980 and inflation adjusted by the U.S. CPI, you end up with about $1,521, where it's kind of kept track with inflation. But the reason nobody's excited with gold at $1,900, $2,000 is because the costs of mining gold have gone up, and we've doubled the above ground stock of gold since 1980 as a result of those initial increases. So the low-hanging fruit, the better grade stuff or the lower grade stuff that was near surface, it has largely been exploited. So in order to really get some life into the juniors that are looking for gold, we need to see a real price increase. That market is seeing a recession coming, and the interest rates are of course a problem. That without the debt ceiling could still push the United States and the rest of the global economy into a recession. And the debt ceiling, if they actually allow it to come to a default, well, then we're in a no man's land that's never been experienced. So who knows how high yields will go and what the negative impact will be. So it's kind of weird. The commodity sector has been like the canary in the coal mine, signaling that we don't like what's coming. And it's had the physical impact of subdued or slowing demand from China, despite its post-zero COVID policy. And that's why we're seeing this nose. I think once we get past this debt ceiling show and find out what the consequences are or what they end up doing, we might end up back into an uptrend. But right now, it's like a Damocles sword hanging over the market's head.
The Federal Reserve's decision to hold the benchmark rate unchanged at 5% to 5.25% is likely to have a mixed impact on the gold market. The decision could lead to increased uncertainty and volatility in the markets, which could drive investors to seek safe haven assets like gold. On the other hand, the decision could also lead to a decline in the value of the U.S. dollar, which could make gold less attractive to investors. As a result, gold prices could be volatile in the near term, but they are likely to remain range-bound in the long term. What factors do you think will affect the future price of gold? What is your personal strategy for investing in gold? Share your thoughts in the comment section. Make sure to like, share, and subscribe to our channel for more updates.